What's up, everyone? It's Scotty with MoneyVest, and today we are going to be talking about the S&P 500 valuation and the earnings season and how did the companies actually do. So I'm going to break all that down. The earnings season is basically over. Over 90% of the companies have already reported. So I wanted to break down the earnings growth, wanted to break down the expectations from analysts going into 2024 and where we are in the current valuation, kind of give you a bird's eye view of the valuation of the market as a whole. So hope you enjoyed this video and find it helpful. I would really appreciate it if you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below. If you're interested in joining, again, there is a 16% annual discount that's available till the end of this month. You get access to all the members-only videos, Excel spreadsheets, Discord access to over 20 plus channels, trade ideas, trade alerts, everything's going to be included. And of course, the valuation spreadsheet that I'm going to go over in this video is also included for all of you. So there's the intrinsic values for individual stocks, the S&P 500 valuation, there's the volatility summary cheat sheet, there's a NASDAQ breadth, market breadth indicators, S&P 500 RSI indicators. So there's a lot of really cool data points and spreadsheets available to all of you. So link's going to be down below. And I also want to mention that the courses are currently 50 to 60% off. We launched a brand new psychology of investing, money and markets course, which I think is going to be incredibly useful for everyone to master your mind when it comes to investing and trading. And the coupon code is going to be Thanksgiving. So you can pretty much access this fundamental analysis, technical analysis, options trading, and psychology. There's four courses included, 50 to 60% off. And finally, Black Friday sale for TradingView as well, 70% off. So this is literally the holiday season. There's tons of discounts if you want to take advantage because after this, if I get emails and messages asking for discounts, like I would be so pissed because this is literally it, right? This is our time of the year when we do offer discounts for TradingView, Teachable, Patreon, Discord, everything's going to be on sale. So going over to analyst expectations for S&P 500's growth. They are expected to improve in the first half of 2024. Now, when you look at the earnings recession, right, there's two different types of recessions. There's the earnings recession and there's an economic recession. The economic recession is basically 2 consecutive quarters of GDP declines for the US, and earnings recession is 2 consecutive quarters of earnings decline for S&P 500 companies. Now, one would argue that last year we already went through an earnings recession because we did see 2 consecutive quarters of earnings declines. But nothing really transpired, right? The earnings recession didn't really transpire into an economic recession. The economy continues to be very strong with low levels of unemployment, high levels of productivity. I mean, we got the GDP numbers, 3.9, 4.9% growth is just absolutely fantastic for the US, given how big it is and what's the size and scale of that economy. But when it comes to earnings, we did expect an earnings recession. We did get one, but we didn't quite transpire into anything else. Now, if you take a look at what we have witnessed in terms of the growth, we have already seen, so for the third quarter, S&P 500 is reporting year-over-year earnings growth of 4.1%. However, for the fourth quarter, analysts are now projecting year-over-year earnings growth of only 3.2%. So that is still some reasonable growth on a year-over-year basis. Now, in the first half, or first quarter, I should say, first quarter of 2024, analysts are now predicting earnings growth of 6.7%, and for the second quarter, they're projecting growth of 10.5% is what they're pricing in. So if you do the math here, 16, 17 divided by 2, we're looking at 8.5% growth on average in the first couple of quarters, and overall earnings growth to be a little over 8 to 10% for the first half of 2024, which again is very, very strong. This right here is going to be the next few quarters of earnings growth. So Q3, we already grew by 4.1%. Fourth quarter, we're expected to grow by 3.2%. And first quarter, 24, 6.7%, and then 10.5%. That 10.5 has been lowered a little bit down from 11.7 from September 30th. This right here also has been lowered a little bit down from 8 to 6.7, and this one has been dramatically lowered in the fourth quarter from 8 to 3.2%. So there is a possibility, at least in my opinion, that analysts might be pricing in something in between these two quarters right here. This is fourth quarter of this year and first quarter of next year. Maybe there is some expectations of economic slowdown, which could suggest why there is a significant decline in earnings growth in the fourth quarter. And first quarter also they're expecting lower than previously anticipated, but they're still expecting growth, right? So they're not expecting declines on a year-over-year basis. This right here is where the earnings growth is going to come from in the first quarter, and majority of that growth is coming from 3 sectors, that is big tech, comm services, consumer discretionary, and information technology. That makes a lot of sense because if you compare this to last year a lot of these stocks were selling off, right? 2022 was absolutely brutal, and we had a lot of big tech, large cap stocks selling off. Energy, on the other hand, did really well. Energy and materials. If you remember, energy had one of the best years in 2022. Excuse me, and I also mentioned specifically that in 2023, energy may not be the best performing sector because its earnings were growing at over 100, 200%. I don't know if you guys remember this. We talked about this on the channel in the past where energy stocks were growing their earnings by over 100, 200% given how high the oil prices were. And since then, obviously, we have seen a significant decline in earnings, not because the earnings are not growing, but because we're comparing against some very, very incredibly high numbers for energy. For tech, which is comm services, IT, consumer discretionary, this includes all of your Metas and Googles and Teslas and Apples and even Microsoft, they're expected to see some very strong growth compared to last year, right? Because again, the numbers were not as strong. We were kind of dealing with higher interest rates, lower consumer spending, and as a result, we did see a pretty significant decline in those numbers. So those are going to be the three sectors that are going to perform potentially well in the first, second quarter in terms of earnings, not in terms of price performance. Those are two very different things. This right here is going to be the growth in the second quarter. So second quarter is now energy, healthcare, once again taking the lead. Comm services, IT starting to pull right back down, with consumer discretionary also only expected to grow at over 6% in that particular sector. Now, this right here is going to be Yardeni Research as well as analyst research for 2023. They're expecting EPS of $2.25, Yardeni Research, and analysts are expecting $220 per share. For next year, for 2024, they're expecting $2.50 and $2.45. And for 2025, they're expecting $2.70 and $2.74. These are the three forecasted earnings per share numbers for the next 3 years for the S&P 500. Now, Goldman Sachs believes that S&P 500 will end 2024 at 4,700. Okay, that represents about a 12-month gain of 4% only. That's it. They're only expecting 4% move to the upside for S&P in 2024 and 2% dividends. That's 6% total. And our 2024 baseline forecast assumes the U.S. economy expands at 2% and earnings rise by 5%, and the S&P 500 P multiple equals 18 times. So right now we're trading at 20, a little bit over 20, which I'll get to in just a minute. And they're expecting for the P multiple to compress down to 18 while earnings growing, and as a result, only a 5%, 4 to 5% growth in actual prices. The S&P 500 P multiple remains above the average level observed since 1990, indicating investors' willingness to pay more for earnings, possibly due to the optimism about future growth. And that's, again, this is from Goldman Sachs, which they talked about how they expect the average price earnings multiple to be closer to 16 or 18, and investors are right now willing to pay a little bit higher than those numbers because they're expecting higher growth. So if you take a look at where we are, right? So $225 is that EPS for 2023 expected, right? 220 to 225. So we are at 45.56. So right now we're trading at over 20 times earnings multiple. So if you do the math, the earnings yield for S&P just dipped below 5%, right? So earnings yield meaning the price to earnings, and you just take that reciprocal, we're looking at 4.94%. In other words, just under 5% is the earnings yield for S&P 500. This is actually lower than a lot of the treasury bonds out there. Now, if you consider the earnings for 2024 at 247, we're trading at 18.45 and then 16 if you consider 2025 numbers. If you take into account analyst expectations, right, that's going to be even lower. So if you do $220, which is the analyst expectations here. So again, if you go back to the previous screenshot, you'll notice that the analysts are expecting $220. Yardeni Research is 225. So if you take 220, 225, we're looking at a valuation for the market, which is somewhere between 20.7 and 20.25. Either way, we're still trading above 20 levels for the S&P 500, which again is higher compared to its 25-year average, 15-year average, and 10-year average as well. It's a little bit lower than its 5-year average at the moment. So in terms of valuation and from a risk-reward standpoint, there's a couple things that I want to mention. Number one, we are trading at a valuation which is higher than its historical average. Okay, that's number one. Number two, if you take the earnings yield, 4.94%, it's lower than where the bond market is trading, right? There's a lot of treasury bonds out there that are trading at 5+% yield on an annual basis. I think it might be the 6 month or the 1 year. So if you come over to the US, let's say 3 month yield, we are looking at 5.429, right? So it's pretty significant. It's only a 3-month yield. There's no term volatility, like in terms of prices moving faster. Like you could buy this, somebody could buy this like 4 times a year, and they're annualizing 5.4%. 6-month bond is also pretty good right now. It's giving you a little bit over 5.469. Again, someone could buy this twice a year and get that annualized rate of return of 5.469, which could be argued is better than obviously the S&P 500, considering that it's trading at over 20 times price earnings multiple with a earnings yield of sub 5%. So, it's going to be quite interesting how the markets trade from here. As I mentioned before, for the markets to see a lot more upside from these levels, one of two things need to happen, right? Number one, either the bond yields need to come down to make equities look more attractive, or equities unfortunately need to come down to make themselves look more attractive, right? So I know it's kind of weird kind of saying that only way the markets can go higher from here is for them to go lower first, right? I know it sounds weird, but that's really how it is, because everything is an opportunity cost. It's a relative opportunity, right? So if you're looking at investing in equities, you're giving up on the opportunity of investing in the bond market. But if you're investing in the bond market, you're giving up on the opportunity to invest in equities. And everything ends up being an opportunity cost at the end of the day. So if equities give us less than 5% earnings yield right now, given the valuation for the markets as a whole, then the bond market, obviously there's a lot more attractiveness on a risk-adjusted basis for that market as opposed to the equities. So that's all I've got for today. Let me know your thoughts down in the comment section below. 45.56 is obviously where we ended up closing. This is the current bird's eye view of the overall market valuation. Again, you can access these charts. All of these are going to be available with the link down below on our Discord and our Patreon. And there's going to be 8 different tabs that you can circle through and access and check out all our analysis with Patreon and Discord as well. So I hope you guys enjoyed this video. Don't forget, we've got the Black Friday sale from TradingView. We've got the fundamental, technical, options, and psychology course on sale, 50 to 60% off. Coupon code is going to be Thanksgiving. Apply that during checkout and you will get a huge discount. And as always, happy investing, and I will see you all in the next video. Make sure that you drop a like and subscribe to the channel as well.